Okay, good morning, everyone. Thank you very much. I'll just let a few people get settled here. Welcome to our seminar on fair share of taxes and sustainable tax planning. Based on the number of people in this room, it sounds like it's going to be a very interesting discussion and a lot of interest, so that's great. Thank you again for coming. My name is Gord Jans. I'm a tax partner in the Canadian firm, PwC. I lead our value chain transformation team. We help our clients design and implement business change in a tax-efficient way. So I'm joined here today by a couple of our colleagues from our global firms. Very pleased to have them here. Isabel Verlinden is a partner from our transfer pricing practice in Europe. She's actually our transfer pricing leader in Europe, Middle East, India, and Africa. Great title. And she's been on the front lines with many of the OECD developments. So you're going to get a firsthand news on the latest developments from the OECD. And I also have Stephen Sang, who is a partner in our US firm but seconded to Shanghai. And Stephen is actually one of my bosses. He's our global value chain transformation leader. And we're pleased to have Stephen in town as well. The fourth speaker today will actually be another one of my bosses, Chris Kong, and he's going to come up in a minute. Just a couple of administrative points. If you have a cell phone or a mobile device, if you could just turn it on mute or turn it off, just so we don't interrupt any of the proceedings. Secondly, some of you might have noticed there's a camera and two really bright lights at the back. That's because we're videotaping this seminar. Don't worry though, when we get to the Q&A part of this session, we will not be replaying any of the questions or the answers on the website when we post this. So please feel free to ask any questions that you would like. And lastly, in your package, there's a lot of material in there, but one of them is a feedback form. And we'd really appreciate your feedback on what you thought was covered well today and any even better ifs that you might think of. So I think with that, I'm going to ask Chris to join us, and we'll get going. Thanks.
Thank you, Gord, and good morning, ladies and gentlemen. I just want to reiterate Gord's comments of welcome, and on behalf of PwC, want to express our appreciation for all of you coming here this morning to listen to some very important topics. Let me find the clicker here. Hopefully I can work it. Yes, indeed. So I have a pretty easy job today with respect to today's topics. I'm just going to say a few words to try and help set the table for today's discussion. And in particular, I'm very pleased that Isabel and Stephen are here from overseas. Isabel, I look forward to hearing her insight and experience into her interactions with the OECD. And then following that, Stephen, looking forward to hearing about his experiences working with multinational companies, particularly on value chain transformation projects. Lastly, I know Gord's got some really good thoughts on the Canadian perspective, and we're going to close with some questions and answers, so please save all your questions. We're going to do our best to answer as many of them as we can. Lastly, you will note that in your packages, the slides are not contained there. We were working last night just to ensure that we had the most up-to-date information to provide for you. So we will be emailing those slides to you after today's session. In fact, one of my colleagues just sent me an email. He's in meetings with the EU, and so it's that kind of up-to-date information that you're going to get today. Okay. Let me just, all right. It's a very big title. So, my family always jokes that there are no television shows that feature tax accountants prominently. And I'm going to include our friends, the tax lawyers and the tax advisors as well. Well, with the recent intense media scrutiny over tax planning by multinationals, we tax accountants, tax advisors may very well have our show quite soon. And I'm not talking just the ones on the websites. Of keen interest to the media, of course, is whether or not companies are paying their fair share of tax. And as well, are companies involved in questionable tax planning and tax avoidance schemes? So let's take a look at who's been in the media recently. We've got Apple in front of Congress. I'm sure you've all seen that. General Motors in Bell South, something happening in Brazil. Let's not forget the UK with Starbucks and Amazon. And speaking of the UK, Google's been said to be doing evil there. And my favorite, even poor Prince Charles can't buy a break. The revenue that he earns, there's some questions as to whether he should be paying corporate or capital gains taxes on that. So, you know, quite an interest overall. And excluding Prince Charles, the executives of a number of these companies have been called in front of hearings of committees of various governments, including those of Congress and that of the UK Public Accounts Committee. And they've been asked questions as to their tax planning, their use of transfer pricing techniques, whether they're involved in tax avoidance, whether there's undue mitigation of tax, whether they're paying their fair share of tax. It's only my own personal observation, but the job of defining what is a fair share of tax really should be those governments themselves defining that. So, with all of the media scrutiny that we have out there, there are an increased number of stakeholders in tax and interest in tax affairs. We heard about Starbucks in the UK and the customers. That's a given. Who else is there? Well, there's, of course, the board and the C-suite. I'll talk about that in a second. Let's not forget investors and analysts, NGOs, non-governmental organizations, and employees. And the interest in, by these stakeholders in tax is now rivaling that, or is equal on par to those, the interest in corporate sustainability policies on the environment, very similar to that. And boards and the C-suites are now taking a lot of interest in tax planning and the overall risk with respect to that. And I know that from conversations with a number of our clients. So tax is increasingly becoming a reputational issue. And we're going to touch on this a bit more later today, but you're going to see that there's probably going to be a need for companies to talk about their tax strategy and for some greater transparency on that. I had a conversation with one of our audit colleagues, and they were pointing out to me that CPAB, the Canadian Public Accountability Board, recently issued some guidance, 10 questions to audit committees. And I'll just read the question. One of the questions they suggested was, what areas represent the company's significant expenses, and are there any jurisdictions where tax rates are so low that it could cause a reputational risk? Well, I won't get into the issue today of whether auditors can actually audit that, but it's certainly interesting that they are also paying attention. And so there is, of course, an increased attention on the ability of companies to shift profits from high to low tax jurisdictions. And to some extent, that's been fueled by governments asking their citizens, the general public, to accept austerity measures, while at the same time, governments are reducing corporate tax rates and general incentives, recognizing there is a global competition for capital necessary for economic investment and jobs and so forth. So despite the need for that economic incentive and which may be appropriate, the media and other parties are putting pressure on governments to deal with base erosion concerns. And a number of politicians globally are taking the lead on this. The most notable that I can think of is UK Prime Minister David Cameron, who has addressed the matter of aggressive tax avoidance. And as you can see, there is quite a bit of discussion, certainly at the recent G8 meetings. I'll also add, though, that it was the same UK Prime Minister David Cameron's government that introduced a UK patent box regime in the UK and some pretty good CFC rules, some favorable CFC rules. So it's interesting to note. Okay. So no surprise then that there's broad support amongst governments to strengthen international guidelines, particularly on areas such as transfer pricing. And the OECD, in response to G20 request, released, of course, its report on BEPS, the base erosion profit shifting, in February of this year. And that project looked at whether MNC's profits are being allocated to jurisdictions, locations different than those where the economic activity has taken place. And they identified 6 key areas, or 6 pressure areas. So the first deals with international mismatches in entity and instrument characterizations, so hybrids. Pressure area on the digital economy, digital goods and services. The treat interest deductibility, related party debt financing, captive insurance, and so on. The effectiveness of anti-avoidance rules, GARs, CFC regimes. Harmful tax regimes. And lastly, transfer pricing, so shifting of risks and intangibles, splitting of ownership, and transactions that may not be undertaken by third parties. So, why focus on BEPS now? Well, from a practical perspective, we're observing that tax authorities are becoming more aggressive in many jurisdictions. And we're starting to see a shift in behavior of certain tax authorities. We're seeing an increase in challenges of taxpayer strategies without changes in law necessarily. Some BEPS-related audits have started in some countries, especially on supply chain structures and permanent establishment issues. And as well, we're starting to see requirements for greater disclosure, certainly not something new here in Canada or the US. So with that, one issue, I guess, that comes to mind is as countries try to deal with these issues, some may start to take unilateral action that probably could cause more mischief and double taxation. So it's very important for countries globally to take a unified and coordinated approach in trying to deal with these issues. The OECD released its action plan in July of this year, and of course there are 15 actions or work plans. All will take about 1 to 2 years to complete. The implications and the practical applications of any recommendations may of course take longer than that. They group the action, we could group the actions into 4 buckets. 1 is some general actions, 2 treaty actions, 3 are permanent establishment and transfer pricing, and 4 data and transparency. And don't worry, I've got them listed in the slides here by bucket. Here we go. I'm going to say that we're not going to talk about these in detail, with the exception of the transfer pricing ones. I'm going to put a plug in for a future seminar that we're planning to have on these, and so watch your email for that. But if I could make 3 general comments on the action plan. Firstly, the plan calls for countries to effectively apply the domestic tax concept of matching deductible payments with taxable receipts. And so while that makes sense, it's going to be that one's going to be challenging to carry through. The second is that the actions seem to emphasize the substance of arrangements as being necessary to all tax planning. And there are the transfer pricing actions, which we're going to hear about. The last one is you'll see again a comment on, or an action on, disclosure of aggressive tax planning arrangements. The broader reporting of aggressive positions is expected, of course, to bring greater awareness of companies' tax planning to governments globally. And whilst it isn't new news here in Canada or the US, it is a major change of policy which, if adopted widely, could cause behavior change much quickly than any change in tax law or treaties. Lastly, as we go through the conversation today, I'd ask you to keep some considerations in mind. I'm going to tie it back to dealing with the stakeholders. So when your executives and yourselves, as you're thinking about how to respond to the various stakeholders, it's important to understand, of course, what your tax strategies are, and making sure that that tax strategy ties into your business strategy. It's important that policies be comprehensive, cover all aspects of tax planning, and that you've got buy-in at all levels within the company. Consider that the strategy needs to be based on a full understanding of an organization's competitive position on effective tax rate and how much you want to maximize the return to investors versus the reputational risks. Secondly, consider how much and whether and when you want to communicate the tax strategy to stakeholders. And when considering doing so, make sure you include and consider all taxes, so your total tax contribution. And also consider what information, if any, you'd like to include with your corporate social responsibility reporting. Lastly, of course, there are a number of internal and external stakeholders, and you're going to get questions on this, but let's not forget a key one, which is the tax authorities. And it's now more than ever important to ensure that the rationale, the support for tax planning is documented appropriately, and that you have a strategy to deal with potentially future audits, which we expect to increase, particularly in the international area. Okay, so with that, I'm going to turn it over to Isabel, and I'll be back later on to take some questions. And I will pass it to Isabel.
Thank you, Chris. Good morning, everybody. I'm so glad to be here, and let me give a bit of background why I'm here. I'm a transfer pricing partner, as Gord was saying, and contrary to what he mentioned about all those titles, what counts is that I spend almost all my time in the trenches with you guys, so I know I see a lot of familiar faces here. And when I started my career, and I stopped counting at 20 years ago, they hired me in a kind of a cellar, and I had to do benchmarkings, and I didn't have the chance to meet with you people. I had to do benchmarkings. Now we have that BEPS thing there, and all of a sudden transfer pricing is glimmering through as the most important thing in international tax planning these days. And this makes me think about a bumper sticker. You have seen those bumper stickers, good girls go to heaven, bad girls go everywhere they want. Well, when I got this invitation, I said, yes, Andy, I swing by in Canada, I'm gonna talk about this thing, I'm happy to do so. But it's a bit striking that transfer pricing is now in that angle, that court of morality. And I'm sure many of us are struggling a bit because where are we? The downside of my 30 minutes here is that I'm always invited to do the boring things. So Chris and so on, they give these introductions, what you find in the press, all fancy, enjoyable, amusing things. Well, amusing, unless it's you that is in the press. But I'm supposed to talk you through some boring stuff. So I try to build in some jokes. I try to be funny. I know I'm not, but anyway, I'm gonna give it a try. What is the context? Well, this could be an OECD official. They were dealing with a number of things that were basically targeting at simplicity. Simplicity for the taxpayer, but also simplicity for the tax inspectors who need to deal with your transfer pricing matters. This is where all these initiatives on risk assessment need to be looked at. So this is a kind of the context. And where do we come from? And I think it's important to highlight a number of these things, particularly when we're starting to talk about BEPS later on. So barely 3 years ago, in 2010, the transfer pricing guidelines were updated, chapters 1, 2, 3. And the messages that came out of it was that, well, it will become harder to get things through the comparability sieve. When I hear OECD officials talking now in public fora, they talk about cookie cutter approaches. The days are gone for cookie cutter approaches, too simplistic approaching of benchmarks. So think harder before you get things through the comparability sieve. But the comparable uncontrolled price remains by far the best method. So do your best to find one, even if it's not a perfect one. Then the question is, but if this is true, why is the transactional net margin method or the comparable profit methods in the US, why is that so popular? Because it's easy, it's pragmatic, it's simple. And this is what we're doing in practice, most of us. The last bullet of that first chapter is paragraph 3.20. Well, what does it mean? In that chapter 3, chapter on comparability, there is a paragraph out there since 3 years who has now become very important and almost unnoticed, because what does it say? Well, if you do your benchmarking, you select the tested party, the most simple party, the low-risk distributor, the contract manufacturer, the whatever. Well, but that paragraph is saying you should also collect information, qualitative information on the non-tested party. What does it mean? And I deliberately say that it went almost unnoticed, because it basically says, well, if you work with a regional entrepreneur company, probably in a tax-effective jurisdiction, what we tend to do in the benchmarks is saying, this is what my contract manufacturer gets, this is what my commissionaire gets, my low-risk distributor. All the rest goes to that tax-effective principal company, and you, Mr. or Mrs. Tax Inspector, you shouldn't ask more questions, because this is what it is, these are transfer pricing principles. But already in 2010, actually, tax inspectors had a basis to ask you more. Asking more in a sense of qualitative information. I underscore that notion, because if they would ask for quantitative information, this would mean that you would by default in a profit split situation, because then you would have to test also what we call in jargon the profit level indicator of the non-tested party. That's not what the OECD asked then. I come back on that a little later. Chapter 9 was introduced, a business restructuring chapter, and interestingly enough, it started off by saying, this is a transfer pricing chapter, we are not interfering with domestic anti-abuse rules. So, and this is also where now the times are changing when we look at BEPS. I'll come back on that later on. Disregarding. When can tax authorities disregard or requalify a certain setup? Well, in very exceptional cases. And this is something that is clearly out there in the transfer pricing guidelines. And there is some fear that now with BEPS and those intangibles discussion drafts, that there is more leeway for tax authorities to disregard more easily. The first intangibles discussion draft came out last year in June, as well as a report on safe harbors. And the most striking paragraph there was a paragraph where the OECD kind of stepped in your shoes, because they were saying if you want to be entitled to an intangible related return, you have to do certain functions physically yourself within your organization. The development, enhancement, maintenance and protection of the intangibles, you have to do it yourself. You can't outsource that. I was at a consultation meeting in November at the OECD, and a tax director of AstraZeneca, he made a fantastic contribution there, because he was saying, hey, we are working with contract research organizations. We are outsourcing clinical tests of drugs on human beings. This is important, and it would be horrible if patients would pass away, but this remains an activity that we are outsourcing. That's what you see in real life, and we, at AstraZeneca, we are pulling the strings. We are saying, we are deciding what to put in the pipeline and what not. So this is something you might need to rethink. And this is actually what the OECD has done prior to issuing the revised discussion draft in July this year. I would like to mention also the United Nations developments, because if we're talking about the OECD agenda, you see sometimes some, let's say, more cynical comments like, hey, what is this club of rich countries doing? These are 34 rich countries. Are they going to dictate the tax agenda globally? What about those 193 countries, including a lot of emerging economies? Do they need to swallow without any further discussion what the OECD is dictating? So that was kind of the background for the United Nations to work on a United Nations transfer pricing manual that came out in October last year. And when you read it, it's 10 chapters, and now I'm gonna address myself more to the, say, cynically enhanced here in the room, because when you read the first 9 chapters, it's like, oh yeah, very much in line with what I see in the OECD guidelines. And then chapter 10 gives country perspectives from 4 emerging economies, Brazil, China, India, and South Africa. And when I was first reading it, I was thinking like, oh, weren't they in the room when they were discussing those 9 previous chapters? What went wrong here? But it was there that you see these countries bringing up the things like market-specific features, market premium. You have access to the Chinese market. If you have access to over 1 billion potential consumers, there is a price tag attached to it, so you're by default in a kind of a profit split. So these types of things is what you saw in Chapter 10, which of course made the OECD a bit nervous. I had some discussions with United Nations officials as well, and I was wondering also why they didn't touch on intangibles. And they said that they would cover intangibles under the comparability chapter in the United Nations manual. Now, only barely a year later, the setup of the teams in the United Nations has been renewed, and now they will also embark on intangibles, just as a matter of information. In April this year, there was the launching of the Transfer Pricing Risk Assessment Handbook. And if you really suffer from insomnia, I invite you to read that thing, because you think, my goodness. But if you read it, you really have to do it, because it talks about effective use of resources. Which resources? Tax authorities' resources. What about your resources? You are even constrained, equally constrained as they are. So this is what we put in our PwC response that was due, I think it was September 13, very recently. Like, hey, we're both in the same boat. We also have to make sure that taxpayers shouldn't spend too much energy and effort, and particularly if that's a potential waste of time and valuable management cost. What are the focus areas? And this is something I would suggest you to take this as a takeaway from this. Websites. What do companies put on their websites? I was surprised. What transactional information do you find on a website? Probably none. So for the pure transfer pricing diehards, it's not relevant what's on the website, but for a tax inspector, it may very well be. I had encounters under MAP procedures in France, where the French authorities were wondering, hey, if you are a low-risk distributor, how can you say that your company is great in France? I was surprised. If you want to sell something, wouldn't it be good to advertise positively on your website? So this is something to think about. What do I have on my website? The risk assessment handbook talks about focus on branch structures compared to legal entity structures. So maybe a bit more focus on branch structures. What about procurement structures where the manufacturing doesn't take place in the country of procurement? What about marketing companies where the marketing company is in jurisdictions where there are no consumers? So these types of things that all go into that thing on substance are very much prominently present in the risk assessment handbook. I also grabbed the occasion to mention the work of the European Commission in this perspective. There is the Transfer Pricing Forum, which is the 27 EU countries together with 16 business members that are talking about pragmatic solutions for transfer pricing matters. And one of those 16, and they're also talking about risk assessment. And believe me, we're very much focusing on making sure that life gets a bit easier also for taxpayers, and that safe harbors and all these things should be more generally accepted. The white paper on documentation came out then in July this year, simultaneously, so to say, with the intangibles revised discussion draft. And this is something that many tax directors probably didn't read either. The focus is really on the intangible thing, but you should read the documentation thing, or at least the last pages of it, because it talks about the global picture, the corporate value chain, the big picture. It talks about this in the context of risk assessment. So for selecting taxpayers for an audit, it could be good to ask for consolidated account, management account. So these types of information that all focus on the system profit. So in our response to the OECD, which is due next week on Tuesday on the 1st of October, we will mention that this is something we understand that you need to be able to discuss the big picture, but that for, let's say, less trained tax inspectors, this might be a door which is wide open to imposing big assessments if you have some sort of disproportionate physical presence in a certain country. So this is something that will not go away. So be prepared in sharing your system profit or telling more to the tax inspector than simply related to the legal entity that is under audit. This won't go away because in November, so in 2 months from now, the OECD will launch a white paper on country-by-country reporting. So beyond what you have already for the extractives, we will have this thing coming out, and this will not go away in the years to come. What is now novel is that with BEPS, a political dimension was added to this. So now I'm going to be funny. And this political dimension is something where certain politicians were very firm about. And maybe there is not a physical resemblance, but this could be Mr. Cameron in the UK, because he's very firm that now these days of immoral tax planning should be coped with. And this is where I deliberately mentioned BEPS as a catalyst of accelerated change. In other words, the OECD was used to throw out discussion drafts. These were discussed, and then they reworked them, and they achieved consensus. Some things were left open, like, for instance, when you look at the business restructuring chapter, some things like exit taxation were not be dealt with in that much detail. But now you see with that political dimension being added that there is momentum to really say now action needs to be taken. And it's novel for the OECD because the OECD gets now a mandate also to coordinate national measures. And this is going to be very, very touchy and difficult. But why is there momentum? Well, I mentioned 4 reasons. You know, we all know that those CFC rules with permanent deferrals from a US perspective are somewhat eye-catching, particularly outside the US. So this is something out there that creates part of the momentum. The Germans have said, well, and the German Minister of Finance, Mr. Schäuble, said in The Guardian a couple of weeks ago that he thinks that the EU should look deeper into these preferential regimes like royalty boxes. And he was particularly mentioning the UK. He didn't do that as long as it was only the Dutch, the Belgians, the Luxembourg who had those little flies on the wall. I can say it because I'm Belgian. But now that the UK is out there with that as well, the Germans are now reacting. So it's got a very political dimension here. France, on the digital economy. How many times didn't you see yet in the press that they're saying, hey, shouldn't a server PE be more prominently seen as something creating nexus? Because now when people are downloading books, it's unfair because there is improper and insufficient taxation in France. And shouldn't we expand those VAT rules? And I'm completely illiterate on VAT, but what I know is that in 2015 there will be the destination principle. So in other words, the VAT rate where the consumer sits, well, the French also wanted to apply for direct taxation. And then the emerging economies. This is where the United Nations dimension comes in, and this is where there is a very fundamental discussion on where source-based taxation as opposed to residency-based taxation would come in. Now, a big debate is currently ongoing on the sustainability of the arm's length principle. I tried to find something that is politically acceptable, so I thought this would do, and I used it at the IFAC conference, and nobody did me bodily harm, so I think it would do. And here I would like to make a reference to what Pascal Saint-Amans, who is heading the tax policy stream at the OECD, is saying. He says, I'm agnostic. I don't care whether it's arm's length or whether it should be global formulary apportionment or anything else. What I'm going to do is find a solution that works, irrespective of what it's called. Now here I'm using the slides of Marlies de Ruiter, with whom I was on a panel at the IFAC conference last month. Marlies de Ruiter is the head of, I think, the tax treaty stream, transfer pricing stream, and financial transactions at the OECD. And she was saying, well, we're going to look into the strengths and the weaknesses of the arm's length principle. And if there are things that doesn't work well, and this is what you find in the BEPS action plan, we're going to find solutions either within are beyond the application of the arm's length principle. Many of us were reading this like, oh my goodness, beyond the arm's length principle. Is this the door open to formulary apportionment? No, it's not necessarily what it says. What it does say is that there are some weaknesses that you simply cannot overcome, and you cannot set them aside by simply doing your homework in traditional transfer pricing application. So you need to take into account that groupness is there. So you have increasing globalization, meaning that it becomes more and more difficult to find comparables. And as I was saying at the beginning, there is more pressure on getting things to the comparability sieve. So what if there are more global companies, you find less comparables? Does this mean that you need to give up the arm's length principle? Not necessarily, but you might want to think about solutions that would work. Now, maybe before I get deeper into that, before suggesting you to dive deeper into these technical things, what I did for the IFA conference is look into the origin of the arm's length principle. So I went back to 1917. So I see a lot of young faces in the room. So if you think you're going to be like 120 years old or something like that, don't bother about trying to catch up with all these developments, because everything comes back. Everything comes back within 100 years or so. We're talking probably about the same thing. Because in 1933, the arm's length principle was born, and they were struggling at that point in time whether they should go for a kind of fractional apportionment or for arm's length principle. They went for arm's length principle under the separate accounting. But throughout the years, they saw that there was base erosion. And with, for instance, in 1962, the Subpart F rules in the US being launched, at that point in time, they were wondering, should we go for what they were calling fractional apportionment, or should we simply introduce CFC rules to put a hold to base erosion? And so they went for CFC rules. So it comes back and back and back, and this is, I think, an interesting observation. So if there are flaws in the arm's length principle, what should we do about it? And this slide, maybe you can't read it on the screen, but these are the slides that Marlies was using at the IFAC conference. So what she says is, particularly, in the interest of time, I will mention two things. Beyond the arm's length principle, we might think about thin cap rules, thin cap ratios, or we might think about commensurate with income standards, so borrowing what we see in the US. On the first topic, she says, you know, what is triggering so much frustration? And if I'm at OECD meetings and I hear the US delegate or the UK delegate talking, it's, you know, we don't want to make life too difficult, but what we don't like is those companies with a couple of billion equity sitting in the Cayman Islands or in Bermuda with no people, and then pretending that these are IP owners or whatever. So these are the very extreme cases we wanna target at. And so we wanna make a distinction between the good ones and the bad ones, but they're not so very clear where they draw the line. But Marlies gave as an example a situation where you are as a group entirely equity funded or almost entirely equity funded, but you are creating a multiple of gearings internally by moving boxes, moving legal entities and things like that. So there can be a potential introduction of some fixed debt equity ratios in the future, and they will find, they said, buy-in from the other countries. They will fight to get that buy-in. The other one is the IP owner with virtually no substance. Maybe there, it's what I was saying earlier, maybe there it's a good time to think about commensurate with income standards to be introduced. So the next slide here talks about risk attribution. When you see, it's section 0.9, I think, when I refer to what Chris was saying earlier, you see a lot of focus on functions and risks. Functionality, important functions, things like that. But what about the risk dimension? Isn't it so that at the end of the day, contractual risk should remain the starting point of Article 9? And this is where she was very firm, like, hey, maybe we didn't pay enough attention to that in the revised discussion draft, and we will clarify this. So in our draft response that we're about to finalize also this week as PwC, we will certainly emphasize this as something very important, like there is no such thing as now functions solely driving the profit attribution related to intangibles. So, value creation. Functional value creation, as I was saying, is very important. It's something the OECD puts a big emphasis on. So for risk assessment purposes, but also in your compliance. So in your comparability analysis, what the OECD is asking you to do is do your homework a bit better, if I can say that, in terms of who is doing what, who is taking which responsibilities, what are the KPIs, what are the performance metrics of the people dealing with that. So these are all things that you need to think about going forward. And then the tested party. This is where that unnoticed thing, that paragraph 3.20 pops in. So this is where the OECD now literally says, well, if you have a party that is a bit more complex than what you think it is, even if you can benchmark it or you think you can benchmark it, well, these parties are not necessarily the parties that should qualify as a tested party. So this is where you see more and more empathy of the OECD with a kind of an introduction of profit splits more or less by default. Probably a very controversial slide, and this is again Marlies' slide, so please don't shoot the messenger. This is where, when I was referring earlier to the example, what you had to do yourself and what you could outsource, this is now where the revised discussion draft takes a different stance than what we saw in the previous version. So in the previous version, as I was saying, OECD said we stepped in your shoes. Now we're saying no, we're not going to dictate what a multinational is authorized to do or not. If you want to outsource things, well, please feel free to do so. But if you are only an IP owner, so you only own the intellectual property, you're the legal owner, but you don't do anything in terms of development, enhancement, protection, maintenance, the only entitlement you will have is a kind of return on capital. So like you would buy kind of a government bond or something of the like. So it's a touchy thing. And I'm an economist, I'm not a lawyer, but I'm sure there are quite some people with law degrees here. Isn't that a bit oversimplifying what the prerogative of control is worth? If you are the IP owner, you can prevent me from using your IP. Isn't that worth something more than what a government bond would earn? So this is probably going to be an area of discussion going forward. But this is the area where you see it already happening in my trenches experiences, particularly on bilateral APAs. These APA authorities, they're asking now, show us the performance metrics, show us the function descriptions. Okay, you have one or two people sitting there in that tax-effective jurisdiction. I'm fine with it, but show us that these are people who are actually pulling the strings. These must be the puppet masters when talking about IP value and the enhancement thereof. So, important functions versus significant people functions. So I will shut up in 3 minutes because Gord was showing me a 5, so I have 5 minutes. But I only take up 3, Gord, so no worries. One of the worries is if you see the notion important functions being introduced, we are transfer pricing practitioners. This is an Article 9 assessment. But we have Article 7, the permanent establishment business profit article that talks about significant people functions. So, and as you are hearing based on my bad accent, I'm not a native speaker, but what is the difference between an important function and a significant people function? I was struggling with it, and I'm going to be funny again. What does that mean? And this is something, I think this is extremely important because Marlies from the OECD was so kind to explicitly mention in the IFAC conference that the OECD in no way wants to mingle Article 7 with Article 9. Article 7 means significant people functions are the starting point. So capital follows risk, risk follows people functions. This is not what the OECD wants you to do or to see in terms of intangibles. Contractual allocation is going to remain the starting point, even though they didn't emphasize it maybe enough in the draft. But how do you allocate risk based on your contracts? This is the starting point. And only if there is a mismatch between actual conduct, a big mismatch, then there will be a possibility to requalify or to disregard. So the message is probably not as harsh as some of us might have thought, including myself when I did a first reading of the first discussion draft. So 3 takeaways, and these are takeaways, this was our conclusion at the IFAC conference. And in my panel, I had, besides Marlies, I had practitioners, but also Madame Wang. For those amongst you who are in APA negotiations in China, so you can run, but you can't hide from her because you have to meet with Madame Wang. And she's she's an advocate of these market features, these types of things. So as you probably know, when we're talking about transfer pricing for emerging economies, the Chinese view is very important. But the reason for bringing it up here is that she agreed with the conclusions. So these are literally the conclusions that we reached at the IFAC conference. So first of all, the arm's length principle is still the guiding principle. So there is no such thing as those emerging economies particularly wanting us to think about global formulary apportionment. But we need to look deeper into the quality of our benchmarks. So we might need to do more benchmarks, more homework when we do the functional analysis around that. And yes, there might be instances, as I was mentioning, where solutions beyond the arm's length principle, like commensurate with income, would be appropriate, or fixed in cap ratios. The second one, and this is probably a takeaway that is very important for the pure transfer pricing practitioners in the room. It's about transparency, it's about communication, it's about documentation. Those days are gone that you can simply focus on the tested party. You have to be more, provide more information, be more informative on the corporate value chain. Even though it's mentioned for risk assessment purposes, Marlies agreed that I was underlining risk assessment purposes, we all know that in practice it will be the question whether all tax authorities will behave in the same way. But there will be an increased two-sided approach, so we will have to do more in terms of profit splits, maybe not as the primary method, but maybe as a corroboration method. So this is something unavoidable. Article 7, Article 9, 2 different things. This was stated very clearly. The third one, very important, the approach will be more difficult for complex transactions, so we might need to do more homework, do the contribution analysis, these types of things. But this equally means that there should be more empathy with safe harbors. For less complex transactions, for God's sake, can't tax inspectors be more empathic with us using more safe harbors? And then the OECD is working on a template on transparency. So transparency is something that is not going to go away very soon. Finally, and this is the more, I think, etheric part of what we said at the IFAC conference, and maybe also something that is more like a sign to the political world. And it is that, well, if politicians are saying that we are, as tax practitioners, might think more about morality, what we are saying is, yes, we're going to pay more attention. If we want to do tax planning, there is nothing wrong with it. But if there is economic activity in those countries and we are transparent about it, what's wrong with tax planning? But make sure, politicians, that the tax inspectors in your respective countries are well trained, because you have more and more initiatives on cooperative compliance, enhanced relationship, horizontal monitoring, these types of things. And it's so good to talk to people who are as knowledgeable as you guys are when dealing with risk assessment or tax audits. And then finally, as an action point also in BEPS, more attention is to be paid to mutual agreement procedures to make it work in practice. Maybe if you allow me 30 more seconds to give you an example. As a European, in the Joint Transfer Pricing Forum, we were working on the monitoring of the Arbitration Convention. So not arbitration in the sense of the OECD Model Treaty in Article 25, but the European Arbitration Convention. which says if there is double taxation, you can put a case into arbitration. Now, the German delegation made a reservation because they were saying, no. According to domestic interpretation, we can only put a case into arbitration if it's double taxation as a result of arm's length issues. And thin cap for us, it's domestic anti-abuse, it's not transfer pricing. So you can't put a thin cap case into arbitration. And you know what happens? If Germany makes a reservation in Europe, it's like a domino. All of a sudden, 9 countries made this type of reservation. So a lot of work is to do in that context. And so it would be a great help if all of you could help us passing on this message that we really want MAP, arbitration, these things to work better in the future. So with this, I would like to stop preaching and hand over to Gord. So thank you very much for your attention.
Thank you, Isabel. That's fantastic. I think actually last night you mentioned there's something like 4,000 MAP cases globally, which is a staggering number when you think about it.
There are 4,000, and in arbitration, sorry, and then I shut up, I promise. I promise, but I never keep my promise because I'm a bad girl, as you know. There are 700 or so under arbitration, and for those who follow a bit the European statistics, 2 cases or 3 cases so far have been concluded under an arbitration procedure. So if you're looking for a lifetime employment guarantee, become a lawyer in these types of things.
Great. So actually, we're going to switch it over to Stephen, give us a bit of the perspective from the global side of things, as well as talking about, in some detail, a model that he's been developing and working on with some clients in terms of how you might stick handle your way through these types of issues on a practical basis. Stephen?
Sure. Yeah, so thank you, Isabel and Gore. It's definitely a hard act to follow, but I myself actually started my career in transfer pricing. And in fact, it was last week I met my old boss from 20 years ago, and I thank him for his mentorship and guidance, especially for sending me to libraries to look up data for benchmarking, because back then I think databases weren't as developed as it is today. But needless to say that I did spend a lot of time, first in transfer pricing, and more recently with our consulting colleagues, helping companies in their delivery of growth agenda, mainly through business transformation. Through this process, we realized a few key points. Again, what Chris actually highlighted is that there is a behavioral change, mainly due to BEPS. We're seeing a greater alignment of tax strategy with corporate strategy. Isabel is pointing out that BEPS is in fact a catalyst that's accelerating this change, where we're seeing a greater focus on how profit attribution could be linked to value creation, also more attention to corporate value chain. But again, these terms such as benefit, value creation, value chain, especially in front of a tax professional or transfer pricing specialist, seems to be quite a technical term. So what we're trying to do is, as we are approaching the C-suite and the board in resolving a lot of their growth issues, try to put tax in the context of what multinationals are actually faced with. Again, not surprisingly, besides all the issues they're facing on the regulatory front that BEPS is imposing, there's several other issues that they're constantly being confronted with. Number one is managing supply chain through extreme market volatility. Again, in a lot of the conversations that we are engaged in, market volatility is the #1 concern facing a lot of companies. Disruptive events, rapidly evolving sales channel, war for talent, technological revolution, and industry-wide transformation. So it's as if companies do not have enough issues to deal with, then we have BEPS. So in a way, behaviors are changed that legal and tax structure cannot be planned in isolation. In fact, BEPS has elevated this as a boardroom issue and actually put tax on par with strategy and operations as part of a sustainable growth agenda. What I have here are actually a quick illustration of what I meant. In fact, when we first think about tax planning, some of my mentors in my career generally give me the advice that to focus on tax planning, especially from the tax side, you need a lot of courage. What he or she means is, ideally, you really want to disturb business as little as possible. In fact, sometimes conversation may be quite uncomfortable, and there might be suggested changes that we may need to make to supply chain. In the end, what we're focusing on is primarily using tax benefit as a driver, and from the operational side, ironically, it's actually viewed as a cost for implementing such a structure. So the whole benefit for the group is actually a net benefit. So benefit from legal structure, cost from implementation from the operational side, often meeting a lot of political resistance, and you have a net benefit. What has changed because of BEPS is, again, because this has been elevated as a boardroom agenda, those with existing structure are summoned by boards and C-suite to address potential exposure. Those who are considering to implement new structures are forced to address the viability of such a structure. And then because of the publicity and the transparency of a lot of these structures, those who are unaware of such structures, again, I'm counting a lot of the CEOs from emerging markets, they're actually challenging their tax department to explore the advantage and disadvantages enjoyed by competitors in the same industry. In all cases, tax directors are being brought into these core strategic and operational initiative to transform business models, where in the past, tax unfortunately only play at best a supporting role. So what we're seeing right now is, once you're involved in these discussions, there are a lot of strategic and operational initiatives to improve operational benefit. As what we have heard from our esteemed speakers before, BEPS is challenging us. In fact, in order to prevent tax from being a cost to an impediment to operational benefit, we need to turn the arrow around and make sure that tax is actually viewed as an enhancement to whatever benefit that will deliver purely from a strategic and operational side. And to do so, in order to equip tax directors with such a increased responsibility, there are some tools and frameworks we find quite helpful in such discussions. This is a framework that's based on our research, including cumulative experience in helping companies, large and small, to transform their business model and supply chain. Again, we concluded that the path to globalization actually includes different stages of maturity. And this is mainly driven by the business environment that they face today, as well as the core competencies they have, as well as the strategic direction they use to leverage. And these are the 4 different models that we roughly characterize as domestic, export, regionalize, or originate, which I'll discuss in greater detail. And again, our research and discussion with executives actually resulted in this framework, what we're calling the value chain transformation globalization maturity framework. This will enable multinationals to assess the changes that will require in the various dimensions of their management, operational, and legal structure I say migrate to the most appropriate business model. In fact, no longer is tax benefit or financial benefit the sole outcome of this. Operational benefit, so those you see on the side, including improved delivery to customer, increased sales, higher enterprise EBIT margin, improved cash flow, and sustainability. These will go hand in hand as we manage total tax exposure much more effectively. So what are some of these models that we discuss? We realize that really not one model will fit all in all circumstances. And as I mentioned before, depending on your administrative heritage, your core competencies, your competitive strategy, models are appropriate at different stage in your globalization maturity journey. These, for instance, the domestic model is often a decentralized federation. This is actually occurring at the beginning of your internationalization expansion. You may be the leader in your home market, but generally expansion is through outright acquisitions of competitors in foreign countries. The export model, this is a very centralized organization. It allows companies to scale up, but basically a lot of the resources are heavily centralized still at the home country. Then we have this regionalized model. This is more a centralized regional hub with again, sub-hubs, and then individual locations. This is characterized as a more of a coordinated federation. Finally, we have this originate model. This is probably some of the newer business model that we're seeing in the marketplace, where we have a very globally integrated network. It's unclear which of these entities are actually the head office. In fact, they would often jointly develop IP together, share IP across the board. This is by no means a unidirectional change, depending on industry, depending on phases of development. Some may even start here, migrate here. Some may even start here and migrate here. So what we're finding out is if there's a framework that we could actually systematically take note on where you are in the stage of development across these dimensions, as you move along this globalization maturity curve, you may have to change your business model to meet various objectives, strategic requirements in order to stay competitive. Now, once we align some of these dimensions, whether it is management structure-related dimensions, such as talent and governance, or operational structure-related dimensions, such as market reach, market offering, operations, procurement, IP management, service, and partnership, a greater understanding of where we are, where we want to be, will lead us to a greater efficiency in alignment of the legal structure, which involves capital, legal, and economics, which is, to Bill's point, deployment of functions, risks, and assets across all the legal entity. How we put everything together, again, it's a baseline study of where we are. So in black versus where we want to be in blue, target. We could actually benchmark against our competitors or peers in terms of which dimension we should focus on. This will identify the effects of the choice that you're making, with regard to management, operational, and legal structure, identify critical dimensions for success, prioritize initiatives, identify gaps. Again, all these could be combined with a value chain analysis to produce recommendation and focus areas for how you can fulfill your vision for growth. So again, this is my last slide. Essentially, we all want to improve operating margin. This is on the vertical axis. Horizontal axis is about effective tax rate. I have a company in brown that is using a purely tax-driven planning approach. So where focus is on driving tax efficiency, but often without too much consideration for operational structure. What usually happens is there's very little improvement in enterprise value, but because of BEPS, you may actually end up with a U-turn, which is not only an increase in tax exposure, which may be leading to a greater total tax cost, but also, unfortunately, a disruption in supply chain that may be leading to a decrease in overall enterprise value. An example that we have in yellow, again, is a value chain transformation approach, which we're focusing on strategic supply chain movement across different improvements in dimensions as we move to appropriate business model. Based on our experience, we recognize that a higher performing supply chain can actually see 50% higher average annual gross sale, 20% higher profitability, 50% net asset turns, 15% lower supply chain management costs, less than half of the inventory level, and all in all, including a reduction in tax exposure. So as you can see, the ideal case in alignment of your legal structure with your operations and strategy is, as you're embarking on this exercise, improving your operating margin, you're also cognizant of all the greater attention placed on tax exposure by BEPS. We're effectively managing our exposure, controlling our tax costs, therefore leading to a greater increase in overall value. So again, my takeaway is that with tax planning, you should continue to have courage. If you're equipped with the right tools, you can walk confidently into the boardroom, participate in the strategic and operational growth agenda in the C-suite, and ensure that your tax and legal structure is properly aligned with the management and operational structure. We feel that in the post-BEPS world, this is probably a more sustainable approach going forward. So thank you very much.
Great, thank you, Stephen. That was very interesting. I have the pleasure of providing you a perspective from Canada. And I wanted to start a little bit with some slides covering some background and some data points, just sort of set the stage a little bit. And then we'll sort of go into the meat of the slides at the end, just sort of musing on some really practical points that might actually occur in the future. So starting sort of a similar slide to what Chris had started with in terms of the Canadian media coverage. You know, it's certainly been reported here. It certainly hasn't been the same degree of scrutiny. It's not as intense. There aren't as many Canadian companies being named in the press. And so it sort of leads one to sort of a sense of complacency, I guess, a little bit. Jack Mintz always has an interesting perspective on things. And I think perhaps part of the reason why he said what he did is when you think about what corporate tax represents in terms of our revenue as a sort of a percentage of GDP. If you look at the World Bank stats, actually it's been hovering around 12% for Canada for a number of years now. So in the scheme of things, corporate tax is obviously an important source of revenue for the government, but it's literally only 12%. And his question is, should we be focusing on other areas in addition to corporate tax? So what are CEOs saying? Every year for the last 16 years, we've actually done a survey of global CEOs. Our latest report was issued in January of 2013, and it actually contained a few questions that touched on BEPS. As you can see from the slide on the top, 62% of global CEOs are either somewhat or extremely concerned that an increasing tax burden will be a threat to their growth prospects. And that's actually up quite a bit, as you can see, from prior years on that same question. On the bottom, you can see, though, that only 37% of CEOs are actually planning on doing something about it. So they are only 37% intend to focus on either tax planning or tax contribution in the next 12 months. So at the time our survey was performed, CEOs were concerned, but they weren't going to do a lot about it. But it's obviously much higher on the agenda screen now that the BEPS and OECD papers have been issued. So it'll be interesting to see how these stats move up in our next year's survey. From a Canadian perspective, we had 120 CEOs participate in that survey. On this slide shows you some data points comparing Canadian response to the global response as well as the US response. And you see in the chart on the left, from a Canadian CEO perspective, only 38% view increasing tax burden as a top business threat, so much lower. And you also see on the right, only 29% of Canadian CEOs expect to focus on their tax planning approach in the coming 12 months. So it's sort of difficult to say exactly why that would be the case. It might relate to some kind of perception that Canadian rules are already fairly robust, and there's not many that opportunities for tax planning, or it just might be some kind of lag in the awareness factor. Certainly, we would expect that these stats are going to bump up in this question next year, and I guess in our view, this is something that certainly will be on the radar screen of CEOs in Canada in the near future, sort of aligned with what Isabel and Stephen were saying earlier. The other perspective is just to sort of give you a sense of who we actually trade with from a country perspective, and it's probably no surprise that when you think about who we export to and who we import from, we're mainly dealing with OECD countries. The US, UK, and Japan are the leading ones. This chart here just sort of tells you what percentage of our top 10 partners is either OECD or non-OECD members. And so 6% of our exports of our top 10 countries go to non-OECD countries. That's China and South Korea for the most part. And on the import side, it's also China and South Korea are the two leading jurisdictions there. The point here is really to illustrate that even if the final recommendations coming out of BEPS are all adopted by the OECD members across the board, the fact that the issue of whether or not non-OECD members are going to adopt similar principles could actually be relevant in terms of our ability to manage tax controversy. We already know from our own experience that managing controversy with OECD member countries isn't always easy, but this slide here suggests that dealing with that issue going forward will still be a pretty big priority for all of us in this room. So here's a slide on sort of some recent things that are happening from a Canadian legislative perspective. And of course, over the last few years, we've actually taken a number of steps to tighten our rules and close gaps and focus on things like tax evasion and aggressive tax avoidance. So if you think about some of the things that have happened that aren't listed on this slide, you've got the elimination of the partnership deferral rules, you've got the foreign affiliate dumping rules that came in a couple budgets ago, tightening on our thin capitalization limits, foreign tax credit generator rules in our foreign affiliate legislation. This slide identifies some other items, the whistleblower rules, Ontario piggybacking, tax avoidance disclosures, and new reporting requirements for companies in the extractive industries. So Canada is already well on its way to fighting base erosion and profit shifting. Sort of drilling into a little bit more detail, when you sort of think about the 15 BEPS actions, what I tried to do on this slide and the next one is sort of give you an overall sense of where I think we fit in terms of aligning with various initiatives. So for example, in July of this year, we actually released some draft legislation on character conversion transactions. So that, depending on how it evolves, could address in part Action 2 there, hybrid mismatches. We already have a pretty robust CFC regime through our foreign affiliate rules, and those, of course, have been finally legislated. There's years of years of changes that were out there, and finally have all been legislated now. So it's at least part of our law. But as you probably realize, a number of those changes actually tightened a number of aspects of those rules. Thin cap rules have been around for a long time. We use the arm's length principle. We have lots of disclosure rules, right? Think about T106 forms and how much information is required on those, and it's been evolving over the last few years. T1135 reporting, that's just been beefed up. We actually have new reporting now for avoidance transactions on a brand new form I didn't even know the number of until I was doing some prep for this seminar, RC312. Hopefully none of you have to fill that one out. GAR was broadened in 2004 to apply to cross-border transactions. And actually last month in August, Finance issued a consultation paper on treaty shopping. So we're well on our way, right, to dealing with a lot of these issues. Obviously, from a TP perspective, we've got minimum information requirements out there, and those are fairly robust when you think about what's required. So lots of alignment, but it really remains to be seen whether there are going to be more changes. In my view, I think there will. And on the next slide, I wanted to talk about a few areas that might be more likely candidates. So if you think about Action 1 on the digital economy, and Isabelle mentioned how interested France is on that topic, you know, when you think about from a Canadian perspective, we don't have any specific income tax rules dealing with the digital economy. We've taken a principle-based approach to that issue. I remember probably 15 years ago when e-commerce was the hot topic within tax. And our rules are designed to sort of accommodate a variety of situations, and e-commerce was one of them. We chose as a country to fit within our general principles as opposed to putting in something specific. Query whether that position is going to continue depending on what comes out of BEPS. Our domestic PE rules actually haven't changed in many years. Our transfer pricing rules, obviously principle-based. Obviously, OECD guidelines are very important. From a Canadian perspective, the GSK case last year reaffirmed the importance of those principles. But we don't have anything specific in terms of our TP rules that would address perhaps some of the items that are going to come out of Actions 8, 9, and 10. And while we've got a binding resolution process now in our US treaty, that's the exception, not the norm. So it's really based on, so when I look back at these, some of these action items and thought about how our legislation might evolve, these are the ones that I thought probably are more likely to create change, either from a legislative or from an administrative point of view. So specifically, what could change? The first one on there is codification of economic substance with a question mark. And these are just pure speculation on my part. But when you think about how the Canadian case law has evolved over the last number of years, we clearly have a preference to legal substance over economic substance. And if any of you, aren't sure on that, just go back and reread the Shell decision, and specifically what the court said there about the importance of legal substance. So without a legislative change in this area, I think it'll be very difficult for CRA to actually successfully challenge structures based on economic substance approaches. And so if something comes out of BEPS relating to that, it wouldn't surprise me at all if there's some kind of change to law. It might not be broad-based, it might be specific to certain types of transactions, but it wouldn't surprise me to see something like that. What about our treaties? So there's a couple of features of our US treaty that most people in this room would be aware of. One is the limitation of benefit clause. It's very specific, very targeted. And the second is the binding arbitration mechanism I mentioned a second ago. Both of those features are relatively unique features from a Canadian treaty perspective. And so query going forward, whether in new treaties or as part of adopting, the OECD multilateral instrument, whether our treaties will change carte blanche on these types of issues. So far, we actually haven't seen a lot of movement in that regard with some of the newer treaties that have been issued or agreed upon in the last year or so. But stay tuned. Our PE rules, as I mentioned, haven't changed in a bit. And so think about Article, or Paragraph 9, actually, of Article 5 in our US treaty, which has a deemed PE rule, depending on how long somebody's been in the country and what percentage of their income might have been earned here. It was put in there, obviously, to address the Dudney case. But think about whether that kind of an approach, again, depending on what comes out of BEPS, would actually be adopted either domestically or in many other treaties. The other aspect of PEs is to think about how our rules for computing branch profits, aren't really technically aligned with our transfer pricing rules. So if you look at what is required to be computed for taxable income in Section 115, there's no direct link to what 247 requires. So think about whether there will be a link put into the legislation at some point in the future. And lastly, will there be changes to our transfer pricing rules in Section 247? Obviously it's broadly worded now, and both Isabel and Chris, I think, mentioned the possibility of things like commensurate with income rules that the U.S. has put in a few years ago now to deal specifically with intangibles. It's definitely a possibility. It seems to be getting quite a lot of play within the OECD, and of course there is a CRA official that's chairing the working party number 6 that's dealing with the intangibles paper. When you think about the recharacterization rule in 247(2)(b), that is obviously a powerful rule when it's when it can be applied. But there's also, I think, a relatively high threshold in there because it requires somebody to conclude that arm's length parties would not enter into that transaction. So it's not, it's would not, right? A very high threshold to meet because I think if you look hard enough, you can probably find many transactions or it'd be rare to find a transaction that a third party wouldn't actually enter into. So maybe they're going to relax some of that, make it a little bit broader, a little bit easier to get into. Wouldn't surprise me. And then lastly, within the transfer pricing rules, think about whether we're going to actually change sort of the minimum documentation required to avoid penalty exposure. So in the white paper that OECD has issued on documentation, there's a reference to a master file and global data, and query whether some of that global data outside of the Canadian business will be something that's required to be reported on. So in advance of this seminar, we actually had the opportunity to speak with a number of CRA officials. These are some of the comments that we gleaned from that conversation. Obviously, as a G20 country, Canada's endorsed the BEPS initiative, and they're very aware of what's going on within the OECD. Generally, they didn't seem to be too concerned about any of the proposals relating to either BEPS or intangibles or documentation. From their point of view, it sort of seemed, in terms of our reaction to what they were saying, it sort of sounded like business as usual kind of thing from their point of view. We asked them specifically whether they thought, as a result of some of these papers, whether they'd be changing their approach to auditing companies, and they reiterated that they were very comfortable with their risk-based approach to auditing large companies, and that they viewed these initiatives just to be one of the factors that they'd roll into their analysis as time goes on. We also asked whether, from a field audit perspective, would they provide any guidance or instructions to their field audit teams, and the response was sort of a qualified no, I would put it that way. So generally speaking, they wouldn't provide guidance based on non-consensus documents, but they did point out that where drafts that have been issued are consistent with their own policies today, then they can use some of this information to their advantage. Basically, as a result of our discussion, it left me certainly with a clear impression that they it's reasonable to expect that there will be changes either from a legislative or an administrative point of view. So, last slide, just sort of focusing on things that we can focus on now. Generally speaking, I think BEPS warrants a fresh look at your business. And so you've heard that a little bit from Chris, a little bit from Isabel, and certainly in terms of Stephen's discussion today has given you a potential way of doing that. But we believe that BEPS isn't going away, and companies that are proactively interested in managing their risk will actually take the time and effort to do some homework on their end. And so what are the things that you'd like to think about? Well, you should think about your approach to tax governance and tax risk management, and what are your policies in those areas? How do you manage risk? How do you manage tax risk in your organization? Do you have guiding principles for tax planning? How well known is that within your organization? Is it just within the tax group, within the finance group? Or is your board going to be asking you questions? And how prepared are you for those types of discussions and conversations? Have you considered reputational risk? Do you have a view on whether your company name, if it's on the front page of the Globe and Mail, is that something that would concern you? Or how would you deal with that situation if it came up? Obviously, before engaging in a dialogue internally with senior management or the board, you've got to get obviously familiar with the issues, and so hopefully this seminar has been helpful in getting you some of that information. We have a lot of information on this area available through on our website, through our PKNs that we issue. And if any of you are interested in signing up for those, we can easily get that done. But bottom line is, as tax directors, as finance professionals, you need to make sure that there's a good level of awareness within your company on these issues. So remediation is obviously something that you'd only consider if you really thought there was an exposure and if it was a big enough exposure for you to deal with. And it's obviously hard to tell what to remediate at this point in time because we don't have any clear guidance yet from the OECD. But when you think about what they're saying and how they're positioning some of their papers, I think you're getting a clear message that it's not business as usual, and substance actually will matter very much going forward in the future. So get ready for that. We actually, in your package, have a brochure on a service offering we call Offshore Tax Diagnostic. We actually developed it a couple years ago to deal exactly with this kind of situation, so it's a little bit prescient on our part. But that's a pretty scalable and easy process to go through if you need to think about things in a lot more detail. Obviously, following what's going on in the OECD and monitoring what's going on from a Canadian Tax Authority perspective is important. But also thinking about your communication strategy, because it no longer solely, I think, will involve tax departments in of themselves, right? So you're probably going to be interacting with HR, you're probably going to be interacting with investor relations, you're probably going to have a lot more correspondence communication with either C-suite, your audit committee, the board. Many different players in your organization are likely to be asking questions about this. So managing that message both internally and externally, I think, is really wise. When you think about today's age of social media and instant communication, if you're not sort of ready to respond to potential, I won't say leaks, but sources of information about your company that might not be the way that you want to position things, you need to respond very quickly, and so you need to be ready for that. But sort of consistent with what Stephen just talked about as well, from an overall perspective, we actually think BEPS is a positive development for tax and for tax planning, because I think what it does is it elevates the awareness of how you need to do tax planning correctly, how you can do it in a way that's sustainable and supportable in the long run. So if you've got the right people, the right processes, the right systems within the right legal structures, you should be able to get the desired tax result that you're looking for, and you should actually be able to defend it on audit much easier than if you do it a different way. And I think with that, we're going to open it up for questions. Thank you.
Well, what an interesting conversation we've had so far this morning. Thanks to Isabel, Gord, and Stephen for some great thoughts and food for thought. I thought also Gord did a good job in sort of wrapping up some of the points that we started out with at the beginning. So let me, without further ado, I'd like to take some questions. We'd like to take some questions from the floor, and if there are any at this time, if you could get up and please stand up and provide. No? Okay. Well, I've got some questions. You know, one thing, team, that strikes me is I see 1 to 2 years in terms of the action plan, and having followed what the OECD has done and some of the projects that they have tried to do over the years, it does take a long time. So 1 to 2 years to me seems very aggressive for a number of the actions. Could maybe I get some comments from the panel on whether this is realistic, 1 to 2 years in terms of the time frame for some of the actions. Isabel, maybe you start with yourself.
Thank you, Chris. Well, I think from a transfer pricing side, it's probably less problematic than many other things that require changes into treaties. So let me first step outside my safe island and talk about these treaty things. What I've seen in Europe is on action point 2 on the hybrid mismatches. The European Commission has looked into it together with the OECD, and there is going to likely be a change in the parent subsidiary directive to make sure that these hybrid mismatches, so in other words, if you want to have a participation exemption on the receiving side, they might build in the condition that there shouldn't be a deductibility in the other countries. So they're playing with that. But it's of course very hard to have changes in treaties. I also grabbed the occasion to say that I was a bit cynical when I was talking to OECD officials on that multilateral instrument. So it's action point 15. It's like we list 14 actions and then, oh yes, we wrap it up under the multilateral instrument that's going to help. But to respond in concrete terms to your questions, I think on transfer pricing, people like Joe Andrews, is a very senior official dealing with the transfer pricing stream, he's saying we are already complying with everything that BEPS is talking about, and we will land on the revised intangibles discussion draft, and we will do it on a consensus basis. So on transfer pricing, I think a lot of things are happening. Maybe worthwhile mentioning is that Marlies de Ruiter said last week in a public forum that the working group on aggressive tax planning was part of Working Party 10 on exchange of information. So just to refresh memories if needed, Working Party 1 is treaties, Working Party 6 is transfer pricing, and then you have a number of other working parties. And now there will be a separate working party to deal with CFC, so action point 3, thin cap, part of action point 4 and the transfer pricing agenda, as well as everything on aggressive tax planning, so action point number 12. So the OECD goes very fast, and they say that they are committed and that they have that there are 4 words that are important. It's commitment, it's effort, it's momentum, and it's buy-in, and they're very serious about it.
Okay. that they are serious, yes, indeed. One question, I guess, it strikes me, you know, Gord, we talked earlier about the fact that it's certainly a big issue in Europe, this whole fairness of tax and BEPS and so on, and that in time we expect that more of that will come to Canada. To the panel, could you advise our colleagues, folks here today, on how to communicate the impact of BEPS to our CEOs, the boards, in a situation where we have an existing tax structure already in place, an efficient tax structure in place, or we're planning to implement one? What are some general, some practical advice that you could offer? let me start with Stephen.
Sure. I think tax in itself is a fairly technical subject, and again, in quite a few recent discussions with the C-suite and as well as some of the board presentation, generally when we mention some specific tax issues, to my surprise, everyone's silent. Everyone seems to understand and seem to not understand. Whereas when we have other more general business or strategic type question, everyone on the board seems to have a strong idea on how we should sustain our growth, where we should have more investments in terms of HR, supply chain, and so forth. So I think as a tax director, as a tax professional, it's quite important to outline, first of all, the changing environment. Again, this is an environment that's quite unique. As what Isabel pointed out, it's actually an evolution that has gone through maybe for the past 100 years. It's not something that is pitting the corporation against the regulators, but rather something that even the regulators could not even agree amongst themselves. So in that context, a structure that you may have in place or are considering will need to balance all the different stakeholders. And something that I highlighted in my presentation earlier, we really need to somehow link all of those sort of purely tax and legal structure, especially the design aspects of it, to its impact on the various parts of your supply chain. In the past, tax planning seems to be an exercise that's done quite independently of the overall strategic or operational consideration. At best, it's considered as a afterthought. So the more you can introduce tax as a area for serious consideration as you're planning your broader growth agenda would enable that understanding, especially for the non-tax focused members of the C-suite.
I would just add, you know, I guess with every risk, I think, you know, comes an opportunity, and so you can look at the glass being half full or half empty. But I think the idea of, you know, engaging in that dialogue at a serious level within the organization actually gives you the opportunity to either, you know, message the fact that you think your structures that are there today are good and explain exactly why, so there's a better understanding. And perhaps where there's issues, you know, take the opportunity to say, look, we need to invest in this, we need to beef this up, and because we want to either keep the savings that we're realizing, or we actually want to, you know, create some savings and actually implement some changes to our operating model. So you can look at it, the glass being half full or half empty when you communicate these issues.
Okay, well, I almost forgot the question, Chris, so but it's progressing age, probably. Well, what I think is important, if you are at the verge of implementing something tax effective, well, there is nothing wrong with it. And I think this is very clearly something that also those political leaders are saying, because there is that whole discussion going on patent boxes and so on, and they say, well, tax competition is a good thing as long as we honor things like transparency and economic activity. So what I think is a very down-to-earth question you need to ask now is it still a good thing to say, I'm at the verge of implementing something and now I'm going to ask my advisor, how much substance do I need? And well, it's probably more harsh than what I try to be or what I want to be, so I'm going to be offensive, I know, but if I would charge $5 Canadian each time somebody would have asked me the question, I would have retired by now since a long time. It's not a question we can answer, and it's a question you need to answer, and this is the change now. So the tax authorities will say, tell us what it is you do. If you are saying that this person is pulling the strings, you only need 2 persons to lead that operation, fine, but we want to understand how the KPIs of that person work, what the functional description is. So the days are gone that you can say, I'm talking to my tax advisor on this particular part of it. So you really have to talk about the global picture. And I would like to grab the occasion, Chris, if I may, to refer to an article that was published, I think, last week on Thursday. It was about, the German Minister of Finance is very vocal, as I was saying earlier. And apparently he said last year to the US Minister of Finance, like, oh, it are all these evil American companies that are stealing away taxable profits out of Europe. Now what you see, there was an article about a German ERP company. I will not mention it, but it starts with an S and it ends with a P and it's 3 letters. And and what the article says, it's, well, that's an interesting thing because they have an entrepreneur company in Ireland. They have 1% of assets there, 1% of people, but 20% of their profits. So you see, this is the kind of global formulary apportionment thing that is out there in the press. So I understand what Pascal Saint-Amans is saying. Pascal is saying, well, those tax advisors, they're too much into these discussions on defending the arm's length principle. But no, we simply have to deal jointly with what the media are saying about what we are doing as companies.
Thank you all for coming this morning. We really do appreciate it and look forward to seeing you again very soon. Thanks.